Welcome to Nestology. We are your hosts. I'm Jessica.
And I'm Shelley.
And today we have a special guest. Lynsie Gridley is, well, a longtime friend of mine. She's a real estate agent in California, Silicon Valley, right?
Yep, absolutely.
Perfect. So she and I actually have the same business coach. So I've known her for years and she's amazing. So if anybody in California needs help with buying and selling, she's awesome. And we're going to have all of her info in the show notes. But today she's going to talk to us a little bit about investing. So when we first started talking about this episode, we weren't sure quite where we wanted to go with it, what area of investing. And we figured investing 101 might be the best way to start it off. Lots of people who ask, how do we get started? What should we do? What do we need to know? So this is the episode for you. She's going to cover all the basics with us. So welcome, Lynsie. Thank you for joining us.
Thank you.
To hear about
I'm honored to be included. Thank you.
Yes. So I know you work with investors. You also have your own investment properties too. So you're speaking firsthand experience here.
Yep, absolutely.
So Fredericksburg, is that where all your properties are, or where all do you have properties at?
I am spread across the United States. I live in California. I have 2 locally here, and then I decided to expand beyond California as I was building out my portfolio. I bought in Utah, like you said, Fredericksburg, Texas. I have multiple there, and I also have in Destin, Florida.
Love that. Oh my gosh. How do you do it? How do you get started? I don't know. I'm jumping ahead here, Jessica. You got the questions here, but I'm excited to hear this.
Well, I've seen your Fredericksburg ones and they're adorable. So most of our listeners are probably here in the DFW area. So if you're looking to go to wine country, check out her places.
Fabulous.
But yeah, tell us, let's kind of, I guess, start with the types of investing, the long-term versus vacation rentals. So can you run us through some of the options?
Sure. So typically there are 3 categories. People often think of it as 2, long-term and short-term, which is vacation rental property, which is typically 7 days or less, is often referred to as the short-term rental. Long-term rental is going to be a lease property. People think of them as like 12-month lease or more. Sometimes people will look at 6 months. And then there's a third category called midterm rental, which is usually like 30-day to 3 months. Those are often targeted towards traveling nurses, people relocating that just need a temporary place that's already furnished in a great location, but not wanting to commit to it for a year, but also not wanting to pay the higher rates that come with the Airbnb daily rentals. So there's the midterm rental as well category.
And so the short term, okay, that's like VRBO, right? Just, I'm dumbing it down here. So that's like Airbnb, VRBO, that's like the short term, right? Midterm, are most of those furnished?
Most of them are furnished because like I said, a lot of times they're going to be like traveling nurses, doctors, executives that are coming in, being relocated for a company, but not yet ready to buy or rent a place. So they're looking for that landing spot that's nice and comfortable. Those are typically furnished. To go along with that, their name, one of the most common websites that people use to advertise those and find those is actually called Furnished Finders. So that's a common website for that midterm rental timeframe.
Yeah.
Got it.
I see a lot too, at least in our area, with people using it as a transition property, but sell their house, move in there while they build or something. So
yeah, that's what I've seen in this. Yeah, because there's a lot of $1 million plus homes and they want a nice, furnished home to stay in for, during that building period.
Yeah.
Yeah.
So how did you get into this? I'm so excited to hear the story. How do you start?
So fun. So when I was young, my husband and I were talking and it was like, how do you build out your retirement and your long-term goals and wealth? And from my perspective, I was already in real estate sales. I was looking at the people around me that I wanted to learn from and model after. And many of them owned real estate portfolios as their long-term goals for their retirement and their wealth to eventually hand down. So I learned under them asking questions. Most of those people that I initially started asking the questions of, they had long-term rentals nearby them. So it was easier for them to either manage the properties or at least know that they were local. So that's kind of how I learned from it originally. And how we got started originally was in us doing our move up purchases as homeowners, doing it in a way where we would keep the first house, buy the next one, and turn that first house into a rental. And then same thing with that third home. So we had originally started our portfolio by keeping our first and second houses. Our first house is actually still one of our rentals here in California,
Wow.
which is fun because every time I
love that.
picture in it, I'm like, oh, this was my first house and I adore it. So that's how we got started originally.
I love that because I do talk to some clients about that when they're trying to decide, if they have the option, if they could hold on to that property versus not, and I look back, on some of my opportunities in the past. I'm like, dang it, why did I sell that house around the corner? What was I thinking? Oh, I'm kicking myself now. So anyway, yeah, good stuff.
Do you have a preference? Because it sounds like you've got a mix of them between the midterm, short-term, long-term rentals.
It's interesting. My husband and I kind of discuss this every single year as we're deciding on the what's next. The long-term rentals, in my opinion, are a lot less work on a day-to-day basis, month-to-month management standpoint. The cost of owning the long-term rentals is lower from a monthly perspective because when you're paying for midterm or short-term rentals, not only do you have it furnished, you're paying utilities and Wi-Fi and cable, like all these other things that just like someone walking into that VRBO or even kind of hotel mindset, they want everything set and ready to go. I mean, even down to, I'm paying for coffee grounds and toilet paper. Whereas at a long-term rental, I'm paying just for the maintenance, the big items, right? Or calling out the handyman every once in a while. So the expenses on a short-term rental are higher, but the overall nightly rate is going to be higher. So it's all part of that math in the spreadsheet of what makes more sense. And also where, do we have the time to put into them? There's a lot of time to get them up and running. If you're starting from something that's not currently functioning as a short-term rental, getting it ready to go. So the initial input of time, as you know, Jess, getting a place all updated and furnished and ready.
Especially hurricane damaged property.
If you continue to do the property management, keeping that in mind as well, or if you're going to hire a property manager to do it, they're going to take away the day-to-day. So those are all things that we evaluate when we're deciding what's next, long-term, short-term, the rules of each city, which gets stricter and stricter and stricter. So that's definitely something we take into account as well.
Oh, yeah, you're right. Because if you've got some properties, like I think in my area, I've got 2 HOAs, right? I don't think they allow like the VRBO, the short term.
Yep.
But I know they do midterm or full rentals. So I guess
even Dallas as a whole, they've put in new restrictions for vacation rentals, for short-term rentals in the single family homes. So you could have city restrictions prohibiting it.
Interesting. Okay. So you mentioned property managers. So do you manage all these properties or do you have property managers? I can't imagine. That seems like a full-time job.
Great question. In addition to my other full-time job.
Yeah, you've got multiple hats you wear.
I do. I actually manage our long-term rentals because it is less day-to-day effort. And in my opinion, I kind of just have them as a well-oiled machine. I've got my list of people that I would call. I know the processes very well. I've got my forms, all of that. So my long-term rentals, I self-manage. And then my short-term rentals is actually a mix. My ones in Texas, I use a property manager for those ones. For the short-term rentals there. So we have a team that manages all of our places in Texas. And then our Florida one, when we first bought it, we used a property manager to get that one rolled over to us. And then we actually took that one over. I self-managed that one as well. And that one is a short-term rental. So I'm dealing with the VRBO and Airbnb, the responses. There's definitely pros and cons to self-managing. Depending on the day is going to tell you which answer I give you, whether it's worth it or not. So yes, I'm a mix.
I have a property manager and it's a lot of work with the property manager. So I can't imagine that's a lot.
Oh my goodness. Well, okay. So on these long-term, I have more questions than we thought.
Yeah, I don't have any.
And I'm over here writing down all kinds of questions. So on some of these rentals, do you think it's beneficial to have like a home warranty in place? Does that help with that? Or is that, in your opinion, a good idea or not?
That's a great question. Each of them, when we bought them, we did have a home warranty from the time of purchase. Some of the houses we have found that to be useful and we utilized it. Some of them we have not. So it's kind of hit or miss. I think the property, the age of the property, the age of the systems that are in the house. One of ours, we utilized the home warranty to replace the water heater on year one. So that was very helpful. Another property we had a home warranty on and we never utilized it. So I think it really just depends on the age of the home, the age of the systems, primarily when you're making that decision of whether that's useful or not.
And if you have a home warranty, do they, I guess if it's a long term, are they the ones contacting them or do they go through you and then you contact the warranty people?
They go through me and then I contact the warranty people and set it up. And then I have to be the middleman to arrange the service person to come out to the property.
Got it. I'll be quiet for a minute. Sorry.
No, these are good questions. I like it.
So for someone that is looking to get into investing, what are some of the terms that they need to know or calculations? Because there's a lot of acronyms out there and things that they may see, but they don't really know what it means or how you get to that number either.
Yeah, great question. And that's something that is going to help the future investor feel at least slightly more educated on step one, because it can be very overwhelming. You can join a circle conversation with some other investors and they're throwing out all the acronyms and you're like, what is happening and what are they talking about?
What's your ROI and cap rate? And you're like, wait, what's going on here?
Exactly. So let's break down just a couple of those. At least like you said, kind of investing 101, the first couple ones that are very helpful to know because those words are going to get thrown around. One of the most common ones, like you just said, is cap rate. Cap rate is short for capitalization rate, which is people's expected rate of return. We calculate the cap rate from a net operating income. And what's important to know for people that are just getting started as they learn how to calculate net operating income over market value, the net operating income never includes a mortgage. So if you're going to get a mortgage on the property, think of that as a personal choice or an optional choice. What is always included in the net operating income are the things that are not optional. So paying your property taxes, paying for property insurance, those things that are guaranteed fees regardless of who buys it or how much money down or any of that. Those are going to be things that come off of your net so that you can get to that net operating income. So gross income that you're expecting to be coming in, whether that's, a long-term rent property, how much you think is an annual rent on the property, then you're going to subtract out the property taxes and the insurance, because those are things that you have to pay for no matter what. So we don't include mortgage expenses when we're calculating a cap rate.
Good to know.
Some people will talk about cash on cash return, and that's when they are calculating the amount of money that they put into it to buy it. So whether that's a cash payment or just a down payment, if we're talking about short-term rentals, you're also going to include in there your updates to the property, the cost to furnish it, the cost to fill the kitchen with all the little odds and ends that you forget about. So all of that, the cash up front, and you're going to take the cash flow divided by your cash put into the property to come with the calculation of your cash on cash return. And that helps people decide, is this a good use of my cash? How else could I be using my cash? Whether that's putting it into a property, what's my cash on cash return? How long does it take me to get this back? Or if I were to just go put it in the stock market or a high yield savings account, they're going to be comparing that percent number to decide if it's a good use of their cash.
Gotcha.
So that's good that people will often talk about as well when they're deciding what to buy, how much to put down, how much to put into the property. Is this a good use of my cash? The cash on cash return is what they're calculating there. And I think another good one that people are looking at when they're first getting started is kind of, what things do I look at when I'm first investigating? A lot of people will use the term a 1% rule. So if you're standing around a circle or you hear that on a podcast and you're like, what are they talking about? What's a 1%? What they mean by that is that ideally the monthly gross rent of that property that they're discussing would be 1% of the purchase price. So that's just a really quick math to help them decide, should I even look further into this property? And I use that one even still a lot when I'm talking to people or hearing other people. How much does it cost to buy in their place, and what's the rents? Unfortunately, that's not taking into account property taxes, which vary dramatically across the United States, cost of insurance, which right now is a really big discussion.
Yes, it
So that's
is.
just looking at rent versus purchase price. But a lot of people use that as like a baseline before they even go dig in any further.
That's how when I'm sorting, when I have an investor that I'm searching for properties, because, well, our MLS, we have cap rate, we have various things that are in there, but that's relying on the agent to put things in correctly. And how many times I have seen mortgage payments as part of expenses, or they leave something blank so it doesn't calculate. So that's what I'm doing, because I can scroll to see what they say they're collecting for rent. And yeah, sometimes it says I'm collecting $2,000 a month in rent and it's $800,000, and we just skip right on past it. So it is a very quick way to look at it.
Yeah, absolutely. It's the quickest way to get started before you then dig in further. Then you go look at, how did they calculate this cap rate?
Yes.
Like you said, that depends on the listing agent inputting the information
correctly.
And, like you said, some of them are putting in a mortgage, some are not, some don't know how to calculate. In my area, our taxes don't go up every year as much as, for example, Texas.
Yeah.
So a lot of states, they will go to market value every year. In California, they don't. They can only climb so much per year, which is nice. But what happens is a listing agent may be putting in a cap rate at the seller's taxes that they've owned it for 35 years. Yeah. And the taxes are so irrelevant to a current buyer. So what they should be doing is putting in, hey, if you were to buy it right now at this price, this is what your taxes would probably be. They need to be inputting new taxes. And if they didn't, the numbers are very, very off. So again, the cap rate portion of the MLS is only so useful.
Yes. Yeah. So that's just a very, like you said, very quick, easy baseline just to even say, do I want to look into this any further?
Yeah.
Any other terms that you have or suggestions on calculating the returns?
I mean, there's going to be a lot of them. Gross rent multiplier, often referred to as GRM, is one. But again, don't get overwhelmed with all the acronyms and all the names if you're just getting started. Know those first couple ones and use those as your baseline to start digging in. And then I would say, if you are just getting started, practice, play around with these numbers. Just be curious to start to understand, what is cap rate? How do I use this 1% rule to start investigating? Get online, find some properties, whether you want to use an agent or just start playing online through public portals of what's available. Just start calculating, practicing. That's going to help you feel more confident in understanding numbers. Again, these aren't going to have everything included. You may not know how to calculate property taxes, or if there's HOA fees. You definitely don't most likely know the nitty-gritty numbers of mortgage without Shelley's help. Help me understand what these rates are and what my breakdown fees are. But it's definitely going to be a helpful first step. Just, on your evenings or weekends, that's the best way to start educating yourself, is just playing around. Create a little spreadsheet. It does not have to be overcomplicated. I mean, there's a lot of resources online that'll even sell you spreadsheet to analyze properties. It's not that complicated for phase one understanding these numbers for properties.
Gotcha. I was just going to ask about locations. So
me too. That was my question.
When people are looking, because like you have it in multiple states. So how do you determine what area you want to explore? Do you have suggestions?
Every year my answer changes, and that's because I am reading online. I'm listening to podcasts of where other people are interested in. I'm reading news articles of best places to invest. But when you're thinking about that, there's a lot of factors that go into coming up with that answer. What they're looking at is the job market. Are they drawing in? Are they creating all new companies? And there's going to be a lot of population growth. Those kind of things are going to be indicators that it will be a strong rental market, because people are going to need housing. Places where companies are leaving are going to be a lot lower on that list, because there's going to be less demand for rentals. When it's new companies, there's a lot higher demand for rentals because they're just moving into the area. They're just getting started. A lot of people don't want to buy as soon as they move because they want to get their bearings. They want to learn their way around.
Check out the area.
Yep.
See where they really want to be.
Yeah. So keeping tabs on places with new growth is really helpful. And then from there, I look at what are the taxes in that area? Are they stable? Are they considered high or low? What's the type of renter? Sometimes you will hear classification. That would be another term that people often talk about when they're discussing rentals, and they'll talk about A class, B class, C class. This is the type of tenant based on the income category. That's what they're referring to when you hear someone talking about a C class rental. And you're like, what does that mean?
What is that?
Does C stand for commercial? No, they're actually grading them like a teacher's grading scale. A being your top renter, high income, but also high expectation. B being good, solid income, good rental history, probably good job history. Then as you get down lower into the C and even D categories of renters, lower income, lower expectation, maybe lower care of your property. So pros and cons both ways.
Interesting. Okay.
It helps you to know what type of property you need to be looking at. If you're looking in an A class area, that you need to expect that you're going to have higher end finishes and things in that house.
Yes, exactly.
You put a lot of thought into this. Like, I'm thinking, oh, she just likes Florida. She likes the wine country in Fredericksburg, those kind of things. But it's like, wow.
Negatives.
They're not. I
have a property you enjoy going to visit.
Absolutely. That's always a perk of when you start your research and you start figuring out like, where is the draw? So for that example, Fredericksburg was, okay, we knew that we were ready to go into short-term rental. And that one is drawing their visitors from multiple locations. Most of them are driving into Fredericksburg as opposed to places where they rely on flying. So these were things that we were calculating as strengths for the area because they're not drawing on just one metropolitan area. They're drawing on 3 to 4 really big ones that all come in. They're not relying on air travel. So if air travel ever gets shut down or too expensive or undesirable for lots of reasons, people can all drive here. They're all planning. They've already historically been driving here.
Yeah.
So these are things that I'm looking at. And then to add to your comment, like, oh, I like visiting here. How hard is it for me to get here? Doesn't have to be on the spreadsheet of pros and cons, but that's always something we consider, not just for how easy is it for us to enjoy it, but if something comes up and I'm needed, how hard is it for me to get there?
Wow. Have you ever bought a property sight unseen?
I have.
You have?
I have.
Is that
one
scary?
of my Texas properties, actually. So 2 properties, one Texas and one Florida, I bought sight unseen from FaceTime.
Really? Oh my goodness, from FaceTime.
Yep, just trusting my real estate agent. Even though I am a licensed real estate agent, I use an expert in
the area
I have bought because I have to trust their knowledge. They're going to be honest and tell me, is this a good street or a bad street? Are people actually going to like this? Because as an out of area person, I can't look at an online portal, for example, Zillow, and know what they're talking about. I don't know what the house next door looks like. I don't know if this is a good area. So I always use an agent to help me with that. And for 2 different ones, I had been to the area, so I had a good sense of the layout and the community and the locations. But then once I leave town, then my agent is giving me FaceTime tours and standing in the street, showing me what's around, talking about, oh, you can walk to the coffee shop right there in quarter mile, things like that, that are really helpful information for an investment standpoint. But yeah, 2 different ones I have
very cool
bought and closed. I didn't even show up during escrow, closed escrow without ever seeing it. And then,
wow. Did you visit afterwards or have you still not seen them?
I have now seen them. Yeah.
You have now seen them.
Yep.
Well,
but it is funny to show up in a house and be like, oh, I own this. And
I bought this and I've never seen it in person.
Yeah.
That's cool.
We've had some clients who've done that.
Yeah.
Until after closing,
we did.
they saw the house. So, and it wasn't an investment either. It was Oh,
It was
you're talking
their
about-
home.
so
They're
that
like,
was nerve-wracking
oh,
for me.
nerve wracking for them to be like, okay, we're moving in. Like, hope you
Yeah.
like it.
Yeah,
And as
David
the
showed
agent,
up.
that's nerve wracking too.
I
You're
know,
like,
it
oh, I
was.
hope
was
they like
terrified.
it.
I was like, if they don't like it, if they come in here and they're like, oh, it's kind of dark, or
Yeah.
we didn't like this. It doesn't look like the pictures.
Yeah. This
So,
is smaller than you made me think, right? Yeah.
Mhm.
luckily, the ones I've worked with have loved it, but yeah, it's terrifying.
It is.
So
It is scary.
another thing, 1031s, 1031 exchange. Can we talk a little bit about that?
1031 exchange is a national program that is available to investors. And what it is when somebody owns a house as an investment property, meaning this is not their primary residence where they live. They've been collecting rent on it. And in their taxes, they have been filing this property as an income producing property. If they want to sell that home, obviously have the option to just sell it. Then they have a gain, most likely, hopefully, of equity gain that it's gone up in value. And then the government, if you're just selling it, at the end, when you go file taxes, they say, hey, I want to collect some of that. I want to tax you on that gain. That's called your capital gains tax. Ask a CPA to run those numbers for you, not me. I am not one. So there's an option called a 1031 exchange that says, hey, instead of paying my capital gains right now on that sale, I want to go buy a different investment property. And I'm going to roll that money over, and they refer to it as deferring the gains, the taxes that would have been collected. So the IRS doesn't collect taxes on the gain right now. They say, okay, we're going to defer that into your next property. You get to go take all that money and go buy a new property. And if you end up buying for less, they are going to want to collect on the delta in between. You can buy for higher, but the portion that you rolled in becomes deferred gains, and you did not have to pay the property tax, the capital gains tax on that property at the time. A lot of sellers love this because they may have owned it for a lot of years, or maybe they bought a really great investment, went up great equity in just a short amount of time, but they're ready to move that into something else. You can take all of that equity gain into the next one and not be paying that capital gains tax right now. It's a really great option for investors that have a lot of equity but want to diversify it. What's wonderful is that you don't even have to buy like one property for one property. For example, I sold one in California and bought 3 in Texas. So
Love that.
you can spread it out. You can spread that equity out over multiple properties. You still have to meet their time periods. So if you're considering this, look into the rules of 1031 exchange. The IRS has very specific deadlines that you have to meet, and there is no gray area on that. So watch your deadlines closely. But if you can meet them, it's a really great option, and you accomplish it all during those time periods. Like I said, I was able to sell one in California that had a lot of equity, but it did not have very good cash flow because the cost of owning it was so high compared to the rents I was receiving, that for me, it made a lot of sense to diversify that one. Sold one, bought 3, and they've been really great investments.
That's
Well,
amazing.
I know you've been doing that for your clients too, because you were exploring with agents in other states. I know I ran some for you, but having your clients who own property in California, maybe selling one and able to buy a multi-unit, so multi-family, a duplex or apartment building for what they sold one property for. So it's amazing.
Yeah, when you're talking about the time. Oh, sorry.
No, go.
Oh, and I was just going to say, so that time frame, you may have what, I don't know, on average 6 months or something is that normally
off the top of my head, and maybe Jess, you know the numbers off the top of your head, I'm pretty sure that what it is you have 45 days to identify the property.
Okay.
So for example, if I'm helping a client in California and we know we're doing a 1031 exchange, you initiate a 1031 exchange company to help facilitate and be the middleman on this during your process. Once we close escrow on the California, they have 45 days to submit a letter to the IRS that says, here's the addresses of the property or properties that I intend to exchange into. And then you
Gotcha.
have to close escrow on one or more of those on the list. You can put a couple options if you're not certain. A lot of times people are already in escrow on the purchase by that point, so they feel pretty confident. Sometimes you're coming down to the wire on day 45 and you're just like throwing a Hail Mary and putting an address there and hoping
The
it
one
works.
you had isn't working because inspection didn't go well, so you're backing
Yes.
out and you're back to
Yeah.
square one. So list off all the ones you're going to look at.
And that's the risk of what if you put a property on the list and you submitted your letter on day 45 and then inspections didn't go well. If you have to back out of contract, you don't get to start those time periods over. So you want to make sure that what's on the list is something that's a good option to buy and to diversify your funds into. And then the other deadline is the number of days total to close escrow on the purchase. I want to say that's 180 days. I didn't have to watch that one as close because our escrows tend to move much faster than that. That tends to be a little bit more applicable when you're dealing with new construction or maybe even commercial properties, things like that, that have a longer escrow period. Our escrows move faster. So usually it's that first identification period that's the one you're anxiously working hard on, chewing your nails off, trying to make sure that you've got it all nailed down before that 45-day deadline.
It was a scary time for those in like 2021 when things were moving so because I mean, it didn't matter how great your offer was. There were so many. So now it's a lot easier to manage that time frame because things are just at a little bit slower pace.
Yeah.
So.
Yeah. And you have a few more options to choose from, which is helpful.
Yes, at least here, I know we have a lot more inventory out there, so it's helpful to have more options.
Absolutely. Absolutely.
All right. Did you have other questions?
Yes, actually, I did. I had another question. So, have you dived into commercial properties at all?
Great question. I have not done commercial properties. I have done multi-residential, so duplex, triplex, fourplex, even apartment buildings, but not commercial. I have quite a few clients that have done commercial. They really like the non-emotional, it's pure spreadsheet. A lot of the commercial properties, even as an investor buying them, a lot of times they're calculating that the tenant is paying a lot of the expenses.
Oh, absolutely.
So sometimes even referred to as like triple net. So the tenant is paying off all of these expenses. You're just owning it. So it's very different. It's a great option as well. I personally have not invested in commercial yet. So I don't have a ton of personal experience to share with you there.
Well, so I own my office building. So I do own commercial property. And we don't do property management because we're here, we're local, and I own it with my business partner. But yeah, it's a totally different beast.
Oh, yeah.
Honestly, I found it was interesting. It was easier qualification wise than a residential mortgage. And it was a whole building. I was shocked. My banker was like, 5 pages? I signed 5 pages. And I'm like, that's it? Are you kidding me? It was so easy. I'm like, I'm asking for almost the blood of your firstborn child, to get a residential mortgage. Like, this is crazy. I need to buy more buildings. Except for then I'm dealing with, tenant stuff on a regular basis. And maybe this is TMI, but yeah, who I'm going to talk about. But I had a tenant that I literally had to have the conversation with a grown man to make sure he didn't pee all over the bathroom floor in the seat because it was really disturbing the rest of the tenants. And I had to turn one of my bathrooms into women only because the women were getting very upset at how messy the bathroom was. So you deal with different stuff.
Yeah.
Fun times.
Yeah. And very different numbers, right? Like if an HVAC
very different numbers
goes out on my condo in Florida, I'm spending $8,000. And when the HVAC goes out on a commercial building, you're in the hundreds of thousands.
Oh my goodness. Yeah. So we had to do a recent renovation and then we had some insurance changes, right? So we went ahead and replaced the roof before those because the deductible was going to be so high and that roof was going to be astronomically expensive. So we opted to go ahead and replace it early, and because we've got hail and stuff out here, it's like, let's go ahead and do it now. It'll be cheaper just in case.
Yeah. Yep.
Like you said, some people do appreciate though the non-emotional side of it because it's just numbers, it's business. I had an agent on my team at one point and he was like, single guy who didn't understand the emotion going through a move with some of these families. And he's like, why do people cry so much? Why are they so emotional? Yeah, he realized commercial was more for him. He was like, I just want to do the numbers and this is fact. I don't know why people cry.
Yeah.
So, it's funny.
That's very true. Very true.
Far fewer tears in a commercial.
Yes, way less. Did you have any other tips or suggestions for a first-time investor?
I mean, bottom line, like just try learning it, listen to the podcast. Like I said, play around with numbers, make yourself a spreadsheet so that you understand some of the very basics, the 1% rule, the cap rate, cash on cash return, and then just dive in, like pick one, get started. Don't get overwhelmed. I mean, find a mentor if it's somewhere local, if you're going to go out of area, but do it, because real estate investing has been the best financial decision we ever made for our family. And I know that long-term is going to be the greatest wealth that I get to hand down to my children.
Oh,
So
it's amazing.
Learn the things, be educated, but then dive in, do it.
Just jump in.
And then keep doing it.
Well, you
There's
sent me
so many incredible tax benefits to owning them. There's even, it's often referred to as like tax loopholes of owning short-term rentals that really benefit even W-2 earners. So there's a lot of really great things that come from it, even beyond the equity gain and the potential cash flow. So many reasons.
It's like you said, for your family too, and what you're passing down, not just the finances, but these properties, it's a home, it's a potential shelter for family members, because my husband has some family members who have special needs children with lots of health issues and medical bills. Their financial situation would have been horrible to deal with, but there was a house passed down through the family and they're staying there, no mortgage, just paid the utilities. And to be able to do that, if you have a family member, and that's what I keep looking at too, like if our kids, grandkids, great grandkids ever are in a position where they need shelter, they need a home, we want to have that place for them. So
absolutely. Awesome. Well, you have been an inspiration. I love it. And I love your idea, because I talk to clients all the time about, maybe keeping your current home. That's maybe an easier way to get going, because then when you're buying your new primary residence, you only have to put 3 to 5% down, right? Let somebody else pay off that other mortgage and keep doing that. That's an excellent way to do it.
Or
you could even get like a HELOC on the property that you currently own and take that money as the down payment on another property.
Yeah. I always tell people, like, let's let that be our first step of investigation. Yeah. Can we keep it and still do a move up? Because being able to own it is so many great reasons to do so. Like you said, let your renter help pay the mortgage.
Yes. Thank you very much, renter.
That you got started on. You already know all the quirks of the house. You know what's going to go wrong.
Right, exactly. You know what to anticipate.
There's
That's why I was asking about home warranty. I'm like, ooh, that might help maybe. But
yeah. Like, that house always has problems. Let's keep the home warranty going on that one.
Yeah, keep it going. Keep it going.
So that's always a great place to start.
I want to get some of your favorite, maybe you can message me when we're done, some of your favorite podcasts and books that you were talking about. Yeah. And I can share those in the show notes and on our social media channels. So we have some resources.
Yeah, absolutely. Perfect. There's a lot of really great ones out there, and I'm glad to share them for sure.
Absolutely. Real estate mogul, Lynsie. Love that.
Well, thank you so much for joining us and all your knowledge. And I'm going to put your information in the show notes too, so that if anybody is looking for an agent in California, they can reach out to you.
She's fabulous.
Thank you. Yes. Thank you. I would love to help them in California, but also I would love to be a resource for people that are anxious about getting started on investing and just want to have a conversation or someone to coach them through. I would love to help you build your own portfolio and wealth. It's such a great thing. And if I can pass on knowledge that was given to me, I'm glad to. So reach out.
Wow. People take advantage of that. She's a wealth of knowledge.
Oh, well, thank you so much. And thank you for joining us today. Like I said, we'll have links to some of these things on our social media channels. It's Facebook and Instagram at Nestology Podcast.
Thank you for joining us, where we help you make the best of your nest.
Bye.
Bye.